Well, Frank, thanks for joining us.
Thanks, Andrew.
Now, we have seen turmoil in credit markets, particularly in the past week, given what happened in the UK. As an investor, what should you be looking at the moment? Just overnight, we did see those yields come off, but nonetheless, they have been moving higher, obviously, as we've seen central banks lift rates.
Well, Andrew, you're right. It has been a calamitous time in the bond markets and in parts of the global credit market, in fact, particularly the traded market, so traditional fixed income. And just to put that in context with some statistics, if you look at the flagship global bond index, that's actually off about 20% year to date. And that is the worst performance since that index was available over 30 years ago. High yield bonds, they're off 14%, again, worst period since that index was available if you ignore the global financial crisis. And then finally, in the US, where you can get a longer term data set in corporate bonds, that index, I think, is off about 19%. And again, that is the worst performance in 50 years. So these are harrowing statistics if you're if you're a holder of bonds. Of course, to the question that you pose, when you do see really big sell-offs like that, I think you do need to ask the question, is it time to be greedy when others are fearful? And clearly in the bond markets at the moment, people are terrified. So I'd say this is something that your investors or your viewers should be looking at. We are looking at bonds more actively than we have for quite a while. I think, though, that if investors are looking for a defensive part of their portfolio, they shouldn't just think about bonds alone. If you think about what a bond is, it's essentially you giving a loan to a company. You're a creditor to that company. And if you're going to lend to anyone, a company, a borrower, I think you need to think about the full spectrum of available credit that you could invest in, not just unsecured bonds, but senior loans to companies, asset-backed loans, perhaps real estate-backed loans, infrastructure-backed loans as well, for example, and see where you're going to get the best value for your capital.
Well, okay, so you talk about the best value. Where should you be looking then, particularly, I guess, when you compare what's going on in Australia with more globally?
Yeah, well, look, you're right. Australia is a small pond, if you will, and there's a really big global market out there. The other thing about the Australian credit markets, if you're looking at traditional fixed income like bonds, that I think is quite limiting, is that most of the market, I think it's over 80%, are actually loans to financials. And that basically means 4 banks plus Macquarie, 2 regional banks and 2 insurers in Australia. And so you're actually narrowing yourself to a very small industry subset, and you're kind of all in on that segment. So I think what you really want to be doing in Australia is looking at a wider subset, so looking at where you can get exposure to asset-backed debt, as well as corporate-backed debt that is probably in the private markets, and whether the returns are attractive there, which I think they are, and they're also floating rates, so they'll protect you in the kind of environment we're in. Today we're going to see the RBA most likely raise rates again, and so floating rate debt will protect you if you're investing in quality assets there. But I also don't think that people should be afraid to actually go offshore. And there is a big global market out there. Global credit markets, particularly in North America and the US, are very deep. And if you can find ways to get exposure there, whether hedged or unhedged, if you're willing to take currency exposure, I think that that's really a place to start looking. And if we keep seeing these kind of sell-offs in credit markets, there'll be very attractive returns to be had there.
All right, is that your expectation? I mean, it's obviously hard to predict given everything's been so volatile at the moment, but given where we're seeing those interest rates heading at the moment, clearly also as central banks tried to contain inflation, they're likely to remain elevated. They're saying that. So how do you see the next 6 to 12 months then?
Look, Andrew, too many people have been calling the bottom in particularly traditional fixed income markets, bond markets, and I think that's just, they've had a terrible run over the last now probably 12 months, and then they're saying, well, look, it's time to get back into that market. I think you probably will see a little bit more of a sell-off in traditional fixed income, and that will mean that credit spreads, or the cost of capital relative to benchmarks for debt, could continue to increase. And if that's the case, I think you do need to gravitate to quality. You need to gravitate to defensive assets to protect yourself through this period of time, and make sure they're the kind of assets that give you some degree of liquidity, so that when you're ready to allocate more of your portfolio perhaps to a risk-on trade in the future, that you can. So I think you probably will see that. And I also think that discrete issues like what you mentioned earlier and what we saw in the UK last week, you'll continue to see in this kind of environment things come out of left field. No one was talking about LDI or liability-driven investment last week. Now everyone's talking about it. We're talking about some stress in a number of global financial institutions. I think you could continue to see these kind of things pop up. So you need to be ready to capitalise on that.
As we see the costs of capital rise, that's also obviously going to impact earnings going forward.
It will, and the proportion of companies listed on stock exchanges that have their interest coverage ratios that are at a level that I think is stretched, meaning their EBIT relative to the interest or the cost of their liabilities, that sort of area of the market has continued to grow as a proportion of the total market, and that means I think that there will be a number of companies out there who will have some serviceability challenges on their liabilities in the period that we're going into. And again, that's why you need to stick with high quality, I think highly defensive assets, and again, stick with floating rate exposures where you do have some options for liquidity or short duration, so you can keep reconsidering your portfolio and how you're exposed as we go through this period of time.